Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. I've just written a piece which has been published this morning, which speaks about how the road ahead for equities may not be or will be bumpy, let's put it that way. And I think there are multiple factors impacting that, and both Indian equities as well as global equities. Remember, for the world at large, there has been a rally that the world has put behind, and the narrative of or the trial balloon of peak interest rates has been duly punctured. So, in this scenario, it's important as much to talk about bottom up ideas as it is to talk about the global landscape and how our global investors who have options to invest not just in India but elsewhere think about it. Our guest today is Manpreet Gill, CIO Africa, Middle East, and Europe at Standard Chartered. And we'll be talking to Manpreet about whether how, as inflation remains hot in the US, how would it impact various other asset classes? What's the outlook on global emerging markets amidst the mixed global cues? Is the time ripe to bet on gold for diversification purposes? Or, as his note says, that the income window is open? And what's the best allocation strategy at the current juncture? You will not get bottom up ideas from this conversation, but trust me, you'll get a good idea about the landscape as it stands currently. Manpreet Gill Johnson on the show. Manpreet, great having you. Thanks for joining me.
Thanks for having me.
The pleasure is ours. Manpreet, how are you looking at the current landscape? Because I read your note with interest and the caption of the note, how the income window reopened.
Well, I think that really captures where we see the opportunity in global markets today, right? Because we clearly went through a little bit of a window of optimism where markets sort of seem to believe that the Fed was actually on the cusp of starting to cut interest rates. We don't quite agree with that, and we've got a bit of a backup in bond yields. But actually, we're in many sort of major bond asset classes back to yield levels where we were in sort of the mid to late of the fourth quarter. So we've almost gone full circle. But nevertheless, we do think that's a great opportunity for any investors focused on income because the bigger context here is we've been through almost 13 to 14 years of close to zero yields, zero policy rates, very low bond yields across the board. But now we're looking at bond yields that are amongst the highest we've seen in at least a decade, and in some cases more. So we do think that, combined with the fact that we think we're not that far away from a cyclical peak in interest rates, means it's a great time to lock in bond yields, both for total return as well as income investors.
Manpreet, uh, embedded in your thought process is a belief that while the current expectation of peak rates turned out to be futile, at some point of time in the next 12 months, we will see peak rates, and therefore you are utilizing that window in order to invest into income products. Is that a correct assessment?
It is absolutely, and maybe I'll add one. There's one additional point there. So one is yes, we were a bit uncomfortable with the market believing that the Fed was likely to peak. Fed rates were likely to peak below 5%. Because that didn't seem to line up with where the growth in inflation data is. But a little bit above 5%, yes, that's always been our view. If anything, and markets have come back to where our view was of Fed rate peak above 5% and most likely closer to the second quarter or so of the year. Nevertheless, we do believe that will lead to slower economic growth. And look, while there might be a little bit of an upside risk on that Fed view, depending on how inflation plays out, for bond yields, what's equally important is what the economic growth outlook looks like. Because long-term bond yields, at least the two opposing forces there are, on one hand, what you expect Fed rates to be, and on the other hand, how much you expect economic growth to slow. And that's the reason why we may very well have a bit of an overshoot on the short end. But when you think about income investors, what you can get on longer term bond yields, on corporate bond yields, emerging market bond yields, that slowing growth implication of higher rates, we think should avoid yields sort of running away and eventually lead to falling bond yields, which is why we want to take advantage of that window today.
There's a larger belief that India and a few other nations, but amongst the larger nations, India will be the oasis of growth in an otherwise slowing world. The latest GDP print, of course, much lower than estimated, though in line with what the RBI had assessed, is not a surprise by any stretch of imagination. But Manpreet, there are telltale signs that there's a bit of a slowing, a slightly quicker, pacier slowing down. Maybe the higher interest rates don't help, but there are some signs there. Real estate registration, so the cycle is getting disrupted as well. Again, maybe because of higher rates. We aren't quite seeing private sector capex coming up in full steam. How do you look at growth overall and then growth within India? And I'll just add a layer here since you kind of look at investing. Would you believe that uh, equities as a class in India would follow earnings growth, or would the macro slowdown hurt equity sentiment enough?
No, good points. I think look, we'd agree with your point that look from an economic growth perspective, the picture in India does look better in relative terms compared to what's available, most other parts of the world. But I think we need to balance that with the fact that India is not a complete island, right? I mean, if the rest of the world is slowing, led by the US, then one would expect at least some spillover of that into macro data. But from a relative perspective, that still leaves India in a good spot. And I think trying to differentiate between what's a cyclical slowdown, which should not surprise markets dramatically, given interest rates have also been on a rising trend. But also a lot of equity investors are focused on the structural picture, which given what we've seen on the policy front, does still look quite attractive. I think as an investor, the key challenge is what price do you pay for those earnings? Now, because that positive growth picture, our asset allocation view in India is a little bit different. So while globally we're overweight bonds, underweight equities, onshore in India, we actually have a more balanced view between the two because we'd still rather hold more equities than we would, let's say, in the US. But the key challenge here is for valuations to become a bit more reasonable. They have eased somewhat, especially relative to Asia. But that's where, from your question, look, longer term, yes, I mean, Indian equities do correlate quite well with earnings. And that's why structurally we still think it's a great market to be. But in the shorter horizon, a slowing growth could help those valuations ease a little bit, which may be a challenge from a short-term returns perspective, but actually for long-term investors like ourselves, that would be what would be a really good thing.
So is the base assumption that the headline levels for various indices, of course, will move down lower from where we are right now, or could it be a time correction? Part two of my question: would you expect larger cuts, or could these be short lived? And again, the reason why I'm kind of intrigued about these levels is that until December, Jan, what have you. Most people were talking about India as largely being the only place in town. To what's happened in the last 2 months has been quite swift.
Well, I think a little bit of combination of both, right? I think if our view, let's say, leaving aside China for a moment, Chinese markets for a moment, if our view is that the markets elsewhere haven't yet bottomed, then it's quite very well that in absolute terms we do see Indian markets perhaps moderate a little bit from the levels they are at
Okay.
today. The reason but I think the time value is important, and the reason I say that is that correlation, may very well put a downward draft on equity markets, but the fact is that if we are right about a weaker dollar, we are right about Asian equities outperforming, even if that's led by Chinese markets, over the next couple of quarters, that actually should help from a foreign investor flow, nevertheless, and that should put, in our view, a bit of a floor in terms of how much markets might fall, or how whether that may be more short-lived than what we see elsewhere. But it comes to the same point about valuations and what causes those to ease. I think that's really the balance investors are trying to strike. And to your point, look, I mean, when the talk sort of becomes one of Indian markets becoming the best place to be, the oasis. That's always worrying from a positioning perspective, because that means positioning, has become a little one-sided, and that can sometimes hinder, short-term returns at least. So I think that's the way I'd really look at it. I think what one opportunity it does raise from a cyclical perspective is that we are a little more optimistic on Chinese markets, just because the starting point was so bombed out. I mean, China's economy is at a different point where they've just sort of reopened from COVID restrictions. We're getting that big bump in sort of pent up demand, and markets bouncing from extraordinarily low levels. That could be a bit of a cyclical hedge against what we're seeing elsewhere, even if it's for a couple of quarters. But I think the question on Indian markets for most foreign investors like us is, look, fully bought into the structural story. But if we get a bit of easing on valuations, that one-sided positioning, I think that would improve the picture quite a bit.
So how is the positioning currently? Is it Asia and EMs with led by China, followed by fixed income, followed by maybe gold, followed by Indian equities? Is that the larger positioning? What is it? I mean, forget my question. What's the larger positioning?
Sure. Well, we're a little bit more optimistic than on Indian equities than that. But
Acha.
I think top of our list as global investors would be high quality income. To us, when we look around the world as dollar-based investors, that's clearly the standout opportunity, not only because of the yield, but because if, in an economic recession, bond yields usually fall, pricing in lower economic growth. And that, of course, adds a bit of a price gain tailwind as well. But second after that, actually, I'd say are Asian equities. And admittedly, top within Asian equities, a lot of that view is led by Chinese markets. just because of that post-reopening bounce, which we think is not done. China does tend to be a momentum-driven market. But I'd say Indian equities sort of do figure at that level because we're neutral, Indian equities versus Asia ex Japan. We have those valuation concerns, yes. Those positioning, I would argue, has already started to ease to some extent. I mean, just from an analyst perspective, we have seen more neutrals and underweights come through, which in my view is a good thing. At least markets on positioning is not one-sided. But I think that's where I try to look at Indian markets from a relative positioning perspective. I think third, of course, I'd be looking more towards asset classes like gold, more as diversifiers. I think that gold can definitely help. Can help not only if you have short-term volatility. We're a little bit worried about short-lived geopolitical volatility, but it does tend to benefit if bond yields fall, if the dollar falls, which are also core views. I suppose developed market equities, your US equities, European equities, they really are ranking closer to the bottom because we're just not convinced that markets have bottomed, and less so there to do with valuations. We think last year valuation eased a lot. Is the earnings expectations haven't adjusted to price in economic recession. They've started moving in that direction, but if the S&P, for example, earnings tend to fall about an average of 11% through an economic recession, and expectations are still on the positive side. So that's the adjustment we're looking for there.
I've last couple of questions. One of them is on because there are a lot of Indian investors who invest in US tech, either directly or through funds. Now, there has been a bit of a rebound there. One assumption that if indeed the US rates stay higher for longer, that should in principle be negative. But at the other end, if you hear a Cisco call or if you look at Coresight research, the expectations around tech spend and tech usage by multiple companies is not looking dampened at all. If anything, it's fairly buoyant commentary out there. The US consumer is still buying. That should actually augur well for these tech businesses. What's your I know you said that you are neutral US equities, but I'm asking about a specific subset, which is the Nasdaq led performances, and maybe the top names, not necessarily a lot of SaaS product companies, but the top names, because that's where the Indian mutual fund industry is largely investing. That's where probably the retail Indian investor is largely investing. What's your thought there?
Well, we have a slightly different view of US tech. You could almost take a fixed income view and say, look, it's what we call a long duration sector. So in other words, it's an equity sector that tends to be quite sensitive to interest rates in the short run, but quite sensitive to earnings growth in the long run. And by long run, I mean 3 to 5 years, and by short, I mean about 6 to 12 months. And I think that's really the challenge. It's about surviving the mark to market. I think from an earnings growth perspective, look, we do expect tech to do well. And when you start taking, what the next 3 to 5 years look like, whether you're talking about, your traditional large tech, or you're looking at pockets of, more thematic ideas. We looked at themes like cybersecurity, for example, in the past. All of them we think have a positive 3 to 5 year outlook from an earnings perspective. That doesn't mean that the next 6 to 12 month stock returns are likely to be as optimistic, because a lot of more of the earnings in the sector tends to be expectations in the future relative to more traditional sectors, and that in our view is what makes the stock prices much more sensitive to changes in interest rates. Now, if we have indeed seen the peak in bond yields, that could start to limit the damage to the sector. But in our view, we need to get through this peak of Fed rate expectation before we can start to see that sector really perform. So perhaps a sector that requires some patience. But if the goal is sort of a 3 to 5 year horizon, that's really where we think that sector can deliver, because that's where you really start to buy into the earnings growth.
Okay. My final question, and I'm playing the devil's advocate here on gold. Your note said fortress gold, and I'm saying in signs of such high inflation as well, we're failing. I think we're failing to see gold being the inflation hedge of sorts. I don't know if you agree with me, but it seems like that. So, what's the case for investing or buying gold?
No, I completely agree. I actually don't think gold is a great inflation hedge. A lot of data and research out there argues that's a bit of a misnomer. But when we say fortress gold, it's interesting. Fortresses do come under attack, and sometimes they sustain some damage, but usually if they're done well, they tend to hold up. And where we see gold's real value is in its role as a short-term volatility hedge. That we think is the real opportunity today, because look, the long-term financial market view of gold is it sort of performs inverse to what bond yields do, what the US dollar does, because it doesn't offer a yield. If bond yields go down, that's usually good for gold prices. So that, longer term could still be a trend support. But where we've seen gold do a great job in a portfolio is when you get these short-lived bursts of volatility. Volatility lasts a few weeks or a couple of months. Around geopolitical risk events, for example, or you think even at the start of 2022, in the first few weeks of the equity sell-off, gold actually performed that job. It does not perform that role through a prolonged equity market sell-off. Gold usually sells off as well. So 22 has been a great sort of microcosm example of how gold tends to perform. So we're seeing it more as a short-term volatility hedge and longer term as a play on a weaker dollar and lower sort of bond yields. As an inflation hedge, we just rather be more direct. I mean, in US markets, for example, you can buy inflation protected bonds, for example, longer term real assets in the commodity space, for example, or private markets, they tend to be better long term hedges. So inflation hedges are harder to implement than it might seem, but that's not the role we really see for gold.
Fair call. Manpreet, lovely talking to you. Thanks for giving us a top down view of how global CIO looks at various asset classes and options available. Really helps a certain set of investors. So thanks for that.
Thank you very much.
And viewers, thanks for tuning into this edition of The Talking Point.